They built a devoted pack of riders by moving the fiercest workouts from the gym to wherever you choose to break a sweat. Now the training wheels are coming off. Should investors pump the handbrake on Peloton? Or will this IPO have the wind at its back?
Let's face it, we've reached the point in the IPO cycle where all the best merchandise has already been taken public. So the bankers keep pushing lower quality companies at undeservedly high prices without any real regard for the buyers. Buyers like perhaps you. Sometimes it's so obvious that the deal ends up getting pulled or at least postponed, like we saw with WeWork earlier this week. And then tonight, Endeavor, a powerhouse entertainment agency, full disclosure, my agent, pulled its deal this very evening. So why don't we do a postmortem on the Peloton deal so people won't get hurt again? Peloton Interactive, PTON, is a company that makes connected exercise equipment. Every one of these things has a screen where you can stream everything from entertainment to exercise classes right in the comfort of your home. The problem with this busted deal, though, is it went immediately below its IPO price, and then it kept going lower. Why? Timing. Peloton's got great revenue growth, but no earnings. As recently as 3 or 4 months ago, Wall Street might have lapped it up. Now, though, many money managers want companies only that are profitable. That's how you end up with a situation where retail demand for Peloton was strong, but the institutional demand, which wants, again, profitable companies, was nil at 29, with the IPO price. So institutional sellers were more than happy to boot the stock out to wherever they could find, which is why it opened below the price. Hence the failed opening where the big boys dumped the stock and take their lumps, while the little guys get stuck holding the $29 bag, now retailing at $25. It was all too predictable, which is why I predicted it in Squawk on the Street this morning. All I can say is it could have been a lot worse. Just ask the people who bought Smile Direct when it came public at $23. The stock's down more than $10 from that level. So is there a level where it makes sense to own Peloton? Look, the economy is a clever. The company's got a great gimmick, I have to admit. People wouldn't say it's a gimmick, it's a skill set. Using digital technology to create a more compelling exercise experience. In addition to selling machines, they also sell subscriptions that give you access to all sorts of digital fitness classes. Now, regular viewers know that I am a big fan of both the fitness industry and the subscription economy. And when you look at the Peloton financials, they're very impressive. The company now has 511,000 connected fitness subscribers. That's up from 245,000 a year ago, and less than 108,000 2 years ago. In a more normal, less saturated with new deals market, I am telling you, we would have loved this company even better. In 2019 fiscal year, which ended in June, Peloton posted 110% revenue growth, and that was a terrific acceleration from 99% in 2018. Investors typically worship at the order of accelerated revenue growth. However, if you look at the quarter-by-quarter figures, Peloton's revenue growth peaked at 122% in the first quarter of the calendar year, and that slowed to 109% in the most recent quarter. Still, the first quarter is by far the most important. That's when you get all those New Year's resolutions. So maybe the deceleration doesn't even matter. What else? You can see that Peloton is trying to shift from a hardware maker with a service kicker into more of a razor blade business model. In 2017, hardware made up 84% of their total sales. In 2019, it's down to 79%, with subscription revenue rising from 15 to 20% over the same period. You know I am a big proponent of the subscription economy, but it'll take a long time for Peloton to reach a point where the razor blades matter more than the razors, especially if their hardware sales keep accelerating. That's a high-quality problem. All right, how about the negatives? What's the one objection you hear is around a lot of that Peloton's costs that are simply out of control. They're spending too much. The cost of revenue for the hardware business increased by 110% in the latest fiscal year, and the cost of revenues for the services businesses was even worse. It was up 127%, in part because they needed to pay royalties on all the music they licensed for their streaming content. Who wants to exercise without music? All told, Peloton's sales and marketing spending rose by 114%, even faster than their revenue growth. They are heavy advertisers. The ads are quite compelling, but that's too high a marketing quotient for most institutional investors to stomach, at least in this new, more skeptical environment. Then there are the earnings, or more accurately, the lack thereof. Peloton's money-losing operation, it's the latest fiscal year. They had $202 million in losses from operations, and their margins seem to be going in the wrong direction, with the operating margin down from negative 11% in 2018 to negative 22% in 2019. However, most of that was stock-based compensation. When you exclude that, and you look at the adjusted EBITDA margins, most important metric here, they only declined from negative 7% to negative 7.8%. We would have overlooked that 6 months ago. We wouldn't have cared. We wanted growth at any price. But those days are over. Now this market wants okay growth with good profits, not to mention some hefty dividends and big buybacks. That is the exact opposite of Peloton. And when you look at this thing through a more critical lens, the bear thesis practically writes itself. Think about what this company really does. Even better, take a look at this image from the second page of Peloton's prospectus, and I quote, "We are a technology, media, software, product, experience, fitness, design, retail apparel, logistics company," end quote. Well, there's an old adage in football. If you have two quarterbacks, you don't have one. Meaning, if you don't know for sure who to play at your starting quarterback, you don't have any good options. I think the same goes for corporations. If you have 10 buzzwords to describe your business, you don't have one. This reminds me of when Snap, the parent of Snapchat, came public and tried to call itself a camera company. No. Snap, your social media platform. Similarly, while Peloton's pitching itself as a family of businesses with huge cross-selling opportunities, at the end of the day, they make their money selling fitness machines with screens attached and subscriptions to exercise videos. And this is what really worries me. When it comes to the workout business, Peloton's got some very serious competition, whether we're talking about the existing gym chains like Planet Fitness, which nobody like if it's going down a lot, though Lifetime, now private, Equinox, or in-person exercise classes like SoulCycle. Again, you can't own shares in that. Or personal trainers, or even something like Fitbit. To say nothing of other companies that make exercise machines. I know they vehemently disagree with that characterization of themselves. They think they're in the business of making home entertainment machines that make you look great for a small monthly fee, the opposite of showing up at a gym that you don't want to go to. As for the subscription side, there are already half a dozen apps that provide a very similar service, and most of them are a heck of a lot cheaper than Peloton's, without the huge upfront cost of actually buying a new treadmill bike, a new stationary bike or treadmill, although I have to admit, they're attractive. There are a couple other major negatives here. For one thing, this is another IPO where the public shareholders will have hardly any voting rights. There's a dual-class structure that puts all the power in the hands of insiders. Hey, look, the market rebelled against that kind of thing with WeWork. Once again, I think investors are sick of this kind of stuff. The other big problem, Peloton's being sued by a group of musical publishers who allege that the company's using music their artists own without permission. Peloton seems to recognize this is going to cost them. Although, at this point, we don't know how much. Still, even with these negatives, again, I'd be happy to recommend this stock at the right valuation. There aren't many companies with 100% plus revenue growth that's accelerating. But even after pulling back today, Peloton has a $7 billion market cap, which means it's selling for roughly 5 times 2020 sales estimates. Too rich for an entertainment in-home health machine. Now, it's hard to find a good comparison here. Peloton's growing like a high-flying cloud computing stock like Zoom Video, which trades at 37 times 2020 sales. But it's a very different industry, and Zoom is down big from its highs. Again, I think Peloton may have missed its chance. It's just not the kind of stock this market wants. It's been left behind by the Wall Street fashion show, people. Unless the investment bankers start pricing these IPOs a lot lower, institutional investors will continue to greet them with the skepticism that Peloton got today. It will become the norm, not the exception. The bottom line, this is not the kind of market where you want to rush into a newly minted growth stock like Peloton. If you think this stock is enticing, just be patient. I'm betting you'll get a better price. Hey, maybe somewhere between 17 and 23. Until then, wait, because we're in a treacherous market for fast-growing companies with big losses. Until that mindset changes, Peloton will trade like a money-losing exercise cycle company with no soul. In other words, stay away. Francis in Arizona. Francis.
Hello, Mr. Cramer. Pennsylvania, booyah to you.
Yeah, man. Big game tonight, booyah. What's up?
Well, I have a question. In light of Lululemon's recent earnings, will they still be able to spin straw into gold?
I thought that quarter was fabulous. I think management is terrific. I think we're still early on. I think it's a high multiple stock. I think you're going to be able to get it cheaper than it is. But I was blown away. That was one of the best conference calls of the season, along with Nike. Those are the two best. I want you to be careful out there, particularly because now we've got this Endeavor pull, but people are saying bad things about Micron sending little chips down. Things are a little convoluted for the moment. All right, now you have the skinny on Peloton. It's not a bad story, but not at these levels. Not at these these levels. Hey, much more Mad Money ahead. Is the housing market starting to get a lift at last from lower mortgage rates? I'm talking to the CEO of Taylor Morrison Homes, one of the largest in the country, to see what she's thinking. Then, I'm revealing 2 stocks that I know which way the wind blows. I'll tell you the names and what they're signaling. And all your calls, rapid fire, on tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.